Welcome everybody to our Group 5 channel. So today we will talk about the case study of mobile payments, Fintech versus the bank giant. And in this video, we'll cover 5 things. First about the case summary, and the 4 remaining parts is about the question. First, about the case study. Fintech firms aim to revolutionize financial service by serving as an intermediary between consumers and traditional banking system, earning revenue through transaction fees. Traditional banks and credit card companies are now entering the mobile payment market, challenging tech giants and startups, resulting in a competitive landscape. The mobile payment market has experienced significant growth, particularly driven by the millennials and the Gen Z, who prefer smartphone-based transactions over the traditional methods. Despite high adoption rates, actual usage of mobile payment apps remaining relatively low due to slow merchant adoption of NFC technology and consumer preferences for credit and debit cards. Branded proximity payment systems like Apple Pay and Walmart Pay are gaining traction due to their convenience and widespread acceptance. While traditional credit card companies charge fees for transactions, proximity point-of-sale systems are typically free to consumers, contributing to their popularity. Zelle, backed by major U.S. banks, offers instant digital payments between bank customers, but it currently lacks NFC functionality for point-of-sale transactions. Despite its growth, the P2P payment market faces challenges in sustaining utilization growth and remains vulnerable to competition from bank-backed solutions like Zelle. Consumers continue to grapple with various payment options, with many still preferring the familiarity of swiping cards for both online and in-store purchases. While traditional players like banks have the advantage of loyal customer bases in financial resources, the mobile payment landscape remains dynamic and uncertain.
Question number 1. What are the 3 types of mobile payments and how do they differ? Answer. The 3 types of mobile payments are universal proximity payment, branded proximity payment, and P2P payment. Universal proximity payment systems such as Apple Pay, Google Pay, and Samsung Pay can be used at participating merchants as a point-of-sale payment. Meanwhile, branded proximity payment systems such as Walmart Pay also use proximity technology but can be used only at a single merchant store. A third type, P2P payment, involves payment among individuals, which can be used to transfer funds among users who have installed apps such as Venmo, Zelle, or Square Cash.
Question 2. Which age groups are the most likely to adopt mobile payment apps and the reason behind it? So, according to article, millennials and Gen Z are the age groups most likely to adopt and use mobile payment apps. Growth in newer forms of mobile payments is strongest among millennials and Gen Zers, who have significantly decreased their use of checks and who, unlike their parents, are comfortable handling their financial transactions using a smartphone. For instance, more than 70% of millennial smartphone users use P2P mobile payment in 2022, compared to just 38% of baby boomers mobile phone users.
Question 3. Why have fintech startups had a hard time competing with the tech giants? Fintech startups have had a tough time competing with tech giants in the mobile payment market, as evidenced by Venmo's acquisition by PayPal. First, in terms of subscribers, are the technology companies like Apple, Google, Samsung, PayPal, and Square, all of which have major hardware and software mobile payment initiatives. Apple, Google, and Samsung own the hardware and software platform of the ubiquitous smartphone, making the devices and services more useful to consumers, while PayPal and Square operate large-scale online payment processing platforms and apps that can be used on all smartphones. Apple Pay is the leader in mobile proximity payment, with about 45 million users in 2025, followed by Google Pay with around 25 million users and Samsung Pay with about 14 million.
What is Zili and why has it grown so quickly in the last few years? Zili is a digital payment service offered by a consortium of major banks in the United States, allowing bank customers to make instant transfer and payments to another account holders using an app. Its rapid growth in recent years can be attributed to several factors. The first one is consortium of major banks, founded by leading banks like JP Morgan Chase, Wells Fargo, and Bank of America. Zili gained credibility and access to a vast customer base, rapidly expanding its reach across the bank industry. The second one is integration with existing bank service. Zili is tightly integrated with various banking services, including wire transfer, ACH transaction, and check deposit, providing users with a comprehensive banking experience through the app. The next one is user-friendly interface. Zili offers a simple and intuitive interface, make it easier for users to send and receive money using only the recipient email or phone number, thereby enhancing convenience and usability. About the introduction of Zili Quick Pay. Zili introduced Quick Pay in 2017, enabling faster transaction compared to other P2P payment services. This feature appealed to users seeking instant payment solution, contributing to Zili's rapid adoption. And the last one is market dominance. Zili quickly established itself as a dominant player in the P2P mobile payment market, attracting millions of users and processing billions of dollars in transactions. Its extensive network of participating financial institutions further fueled its growth.